Let's illustrate how transfer pricing works through an example of selling goods across national borders. MedDevice Ireland Limited sells medical equipment to MedDevice France SARL, who in turn sells this equipment to a French hospital. Both companies are fully owned by MedDevice Inc., a multinational enterprise or MNE. They are sister companies or associated enterprises. The transfer price is the price at which MedDevice Ireland sells medical equipment to MedDevice France. Or, in more generic terms, the definition of a transfer price is the price used by associated enterprises when they sell to each other. Associated enterprises are sometimes called related companies or controlled parties. They are the opposite of independent companies. Why does transfer pricing even matter? Both legal entities ultimately roll up into the same multinational enterprise anyway. Well, in the process of supplying the product to the customer, the MNE deals with multiple tax jurisdictions. Each country has its own corporate income tax rate, 25% in France, 12.5% in Ireland. The MNE wants to optimize its tax planning while at the same time avoiding the risk of double taxation. Let's calculate several base scenarios for transfer pricing to get a feeling for the range of numbers that we are talking about. The lowest transfer price scenario is the 40,000 euros of manufacturing cost or cost of goods sold per unit that is incurred in the factory in Ireland. The highest transfer price scenario is the selling price of 100,000 euros to the external customer. In other words, there is a gross profit of 60,000 euros to split between Ireland and France. What if we set the transfer price equal to the 40,000 euros manufacturing cost? That would mean that the full gross profit of 60,000 euros will end up in France, gets taxed at 25%, which leads to a tax amount of 15,000 euros. There would be no gross profit in Ireland and therefore no corporate income tax to be paid in Ireland. In total, the tax charge for the MNE is equal to the tax charge in France, 15,000 euros. What if we set the transfer price equal to the 100,000 euros external selling price? That would mean that there is no gross profit and therefore no tax to be paid in France. The full gross profit of 60,000 euros will end up in Ireland, gets taxed at 12.5%, which leads to a tax amount of 7,500 euros. In total, the tax charge for the MNE is equal to the tax charge in Ireland, 7,500 euros. These are two extreme cases. How about we put a third scenario halfway? At the transfer price of 70,000 euros, there is 30,000 euros of gross profit in France, taxed at 25%, and 30,000 euros of gross profit in Ireland, taxed at 12.5%. In total, the tax charge for the MNE is 11,250 euros, and the average tax rate is 18.75%. What we know for sure is that the 100,000 euros transfer price will not fly with the French tax authorities. And we also know that the 40,000 euros transfer price will not fly with the Irish tax authorities. If the multinational enterprise, against their better judgment, pushes ahead with the 100,000 euros transfer price, they run the risk of double taxation. Here's how that could work. After careful review of the situation and the documentation from the MNE, the French tax authorities decide to reject the transfer price of 100,000 euros and mandate a transfer price of 60,000 euros instead, which leads to a gross profit in France of 40,000 euros, taxed at 25%, so a tax charge in France of 10,000 euros, excluding any fines that might be applied for not complying with transfer price rules. The total tax charge is now 17,500 euros. The double taxation situation arises as MedDevice Ireland Ltd might not be able to convince the Irish tax authorities to lower the taxable profit in Ireland accordingly. So if these two extreme scenarios are not the way to go, then how is the right transfer price determined? Starting point is that the multinational enterprise, M&E, takes the initiative to find mutually satisfactory solutions. Mutually satisfactory in the sense of the underlying principle that corporate taxes are paid where profits are earned. Simple, yet profound. Let's zoom out to the transfer pricing big picture. The fundamental principle is that of arm's length transactions. The price should be the same as if the two companies were independent enterprises acting in their own self-interest. If MedDevice Ireland not only sells medical equipment to associated enterprise MedDevice France, but also to an independent distributor in France, then the company has a direct comparable, a market price for an uncontrolled transaction. Assuming, of course, that this distributor operates in a very similar way to MedDevice France, in terms of economic activities, responsibilities, assets used, and risks assumed. This would be a very strong data point to take into account in setting the transfer price, but certainly not the only input. The cornerstone of a company's transfer pricing documentation is functional analysis. Where is the value created? Where is the risk? What is an appropriate compensation or return for the value contributed and risks taken? If more value is created in an entity, then it should be entitled to higher profits. If greater risks are assumed in an entity, then it should be entitled to higher profits. Both of these align with arm's length principles. Functional analysis is a chance to tell the story of your multinational enterprise, and it helps to build well-documented and defendable transfer pricing positions. Here's a high-level overview of what a functional analysis dives into. Economically significant activities and responsibilities undertaken. Assets used or contributed. Risks assumed. MedDevice France performs the functions of marketing and sales, installation, customer training, warranty and repair, and regulatory compliance. MedDevice Ireland performs the functions of manufacturing, quality control, warehousing, and logistics. MedDevice France contributes mostly intangible assets, marketing intangibles like brand name, customer lists and customer relations, and proprietary knowledge on how to diagnose and treat patients on the medical equipment. MedDevice Ireland contributes mostly tangible assets, property, plant and equipment, and inventory. In terms of risks, MedDevice France is on the hook for product liability and warranty claims, as well as the credit risk of late payment or non-payment by the customer, whereas MedDevice Ireland has inventory obsolescence and fixed asset impairment risk. Transfer pricing is very important in international business. Getting a solid understanding of how the company creates value, combined with logical thinking, and the ability to document observations and conclusions carefully will get you very far.